Why is everyone suddenly talking about Section 47? We're in the middle of a global shift. War headlines are everywhere. The silver price on your screen is getting hammered. Twitter and Reddit are full of safe haven memes and panic posts. And in the middle of all that noise, a quiet question keeps popping up in our comments. Is my silver still private? Can they really track my local cash purchases? RateScope here. While everyone is staring at missiles and red candles, the government just quietly flipped a switch in the background, a reporting mechanism that changes the rules for every serious stacker in America. Today, we're going to unpack the secret clause in Section 47 that nobody talked about in the TV soundbites, why its enforcement was timed perfectly with the current silver crash and war headlines, how new aggregated reporting rules turn your small split purchases into giant red flags, and the rules you need to follow if you want your wealth outside the digital net, not pinned inside it like an insect. Don't take my word for it. Take the logic, then check the forms and requirements yourself. 8300, 1099B, and your own storage contracts. Because this isn't just boring compliance. It's the blueprint for a world where your physical metal is the only thing they can't print, and they know it. Let's start with the distraction. In the last few days, silver has been slammed toward $86. Volatility is insane. Safe haven is being mocked in real time. Could price go lower from here? Yes. Does that mean Section 47 is less important? No. It makes it more important. Why? Because the war narrative, US versus Iran, escalation, safe havens, is the front of house show. You're meant to look at the bombs, the charts, the intraday moves, not at the new language and reporting rules, the software being installed at dealers, the quiet activation of Phase 2 enforcement. You've seen this pattern before. War equals fear. Fear equals buy gold and silver. But for some reason the price dumps just as retail piles in. That's the war trap. Big players use the safe haven idea against you. They buy before the headline. They sell into your panic. You think you're hedging risk, they're harvesting you for liquidity. But while everyone is arguing about whether silver failed or not, something else is happening. The IRS $10,000 rule, Section 47's bail-in and reporting logic, and dealer point-of-sale software have all been quietly joined together. The war didn't start this story. It just gave the system the noise cover it needed to turn the key. Let's break down how Section 47 actually works in practice for you. The government knows exactly how stackers think in 2026. They've seen every forum myth and every trick thousands of times. I'll just buy under $10,000 so no one reports it. I'll use cash at my local coin shop so it's invisible. I'll spread my buys around. They can't track all of that. On paper, that used to look clever. Section 47 is about turning all of that into structured data. Think of it as aggregated surveillance. Not one giant form, not one giant raid. A drip feed that builds a map of who buys what, where, and when. Let's walk through the three parts. Step 1. The Software Handshake. In 2026, almost every real bullion dealer, not the backyard guy with a shoebox, is running a digital POS system. That system does more than ring up a sale. It is tied to inventory, logging IDs, tracking payment types, in many cases, built to be reporting ready by design. Here's the logic. You walk in and buy $2,000, $3,000, $4,000 of silver. You show an ID because most legit dealers ask now at fairly low thresholds. That ID, that date, that amount gets stored in the local system. No form has been sent yet. Nothing has hit the IRS that day, but the record exists. Now you come back. Same shop, same ID, new purchase. The system doesn't forget the first one. It adds them up. 3 visits in a month, 5 in a year. Under modern guidance, those can now be treated as related transactions. A single plan to accumulate assets, split into multiple chunks, that collectively cross the old mental line of $10,000. In older, paper-driven days, catching that was hard. Now, dealer software can automatically flag accounts when cumulative buys pass certain thresholds. Prompt the owner, you must file or be ready to file a report on this customer. Keep your ID and purchase history packaged for instant transmission if asked. Remember, Section 47 doesn't have to say, We will record every detail of every stacker's life. It just has to mandate certain e-filing requirements, impose painful fines for non-compliance, and let software developers do the rest. Dealers are not evil here. They're scared. If they miss a pattern and get audited, the punishment can be catastrophic for a small shop. So the path of least resistance is log everything, aggregate everything, assume the system will ask. Step 2. The 1099B expansion. Most people think in terms of buying. How do I avoid reporting on the way in? But Section 47's net also tightens on the way out, when you sell. Traditionally, precious metals triggered 1099B reporting in specific conditions. Certain bar sizes, certain coin quantities, within a 24-hour period, delivered to dealers. There were plenty of ways to avoid certain thresholds, plan sales, stay under the radar if you were small and slow. In 2026, that world is shrinking. The new push is toward cost-basis tracking for more and more metals transactions. The idea, on paper, is we want to know your gains so we can tax them accurately. The actual effect is a much broader net of sales being logged, a much bigger problem if you can't prove when and for how much you bought. If you can't produce your old receipts, have no clear records, and suddenly sell a big chunk, the system can assume your cost basis is zero. Every dollar you receive is taxable gain. And because Section 47's logic is tightly intertwined with 8300 cash reporting, 1099B sales reporting, and dealer software, your private stack becomes a series of logged inflows and outflows that can be reconstructed after the fact. The more tightly 1099B rules are enforced and expanded, the more metadata the system has. Not just who sold what, but who likely bought, when, and for how much. Even if certain coins, like specific eagles, keep special status for 1099B, that doesn't stop. 8300 from pulling in your cash buys, dealer POS logs from building a history, future rules from stepping further across the line. Step 3. The bail-in clause. This is the part almost no one reads because it's buried in the boring language of systemic stability. Section 47 gives the Treasury and regulators expanded emergency oversight during banking and market crises, the ability to coordinate with systemically important institutions, which includes big banks and certain custodians. Now combine that with modern bank resolution rules, bail-in frameworks, and the blurred line between your property in their building versus their liability to you. Ask yourself, if your metal is in a pooled account at a large institution, or in a vault that you access through a bank or brokerage front end, what, legally, are you? A title holder with a specific bar allocated to you? Or an unsecured creditor of that institution with a promise? In a normal day, the difference feels academic. In an emergency resolution, it's the difference between hand them back exactly this bar and restructure these liabilities to stabilize the system. If the same structures that gave us spoofing scandals, the same banks that paid fines for manipulation, are the ones holding your paper silver or pooled metal under Section 47's umbrella, you have to ask, when push comes to shove, does this clause protect me or them? Bail-ins are, by design, about protecting institutions, by forcing creditors to absorb losses. If your arrangement makes you a creditor, Section 47's systemic stability language is not your friend. So what's actually live now beneath the noise? Think two-tier reporting system. Tier 1, front door, obvious stuff. Single large cash transactions, big bar sales, high value, easy to spot moves. Tier 2, aggregated algorithmic stuff. Series of smaller buys from the same dealer, repeated modest sales that add up, inflows and outflows across institutions that can be matched later. Section 47 is less about the headline rule and more about the plumbing that connects these tiers, the software handshakes, the optional now, mandatory later frameworks. Now layer the war and silver crash on top of this. When silver gets smashed from, say, the low 90s to the mid-80s ahead of March, retail gets scared or excited depending on bias. Some panic sell physical back to dealers. Others panic buy cheap dip with cash. Either way, volume flows into the channels most tightly wired to Section 47's net: dealers, banks, custodians. The price move distracts you. The flow move enriches the data set. That's the point. So what do you do if you're serious about stacking in this new environment? Let's turn Section 47 from a black box into a set of rules you can work around, not get crushed by. Rule 1. Kill the fake safe havens. If your metal exposure is a leveraged ETF, a synthetic certificate, a pooled account at a systemically important bank, you are not inside the vault. You are inside the financial system, as another line item, Section 47, effectively says. In stress, we care more about the system's survival than about individual unsecured promises. If you're holding a promise on a screen, you are on the menu in that scenario. That doesn't mean never trading or using paper for speculation, but don't call that your hedge. Rule 2. If you use vaults, demand real bailment. True bailment means specific items are held for you, segregated from the company's assets, clearly titled in your name or entity, recoverable even if the vault operator goes bankrupt. Ask questions like, is this allocated segregated metal? Is there any rehypothecation language? If you go into receivership, am I a client retrieving property or a creditor in line? If they can't or won't answer clearly, bury you in vague legalese, or treat your metal as part of their balance sheet, you're closer to a bail-in candidate than a protected owner. Rule 3. Stop playing the 5-minute war game. Every time a crisis hits, a headline breaks, a war escalates, the same vultures come out, pushing safe haven stories, pumping price into thin air, dumping into your panic. If you let war headlines, intraday candles, Twitter sentiment dictate when you buy and sell, you are playing their game. Section 47 makes that game worse because each emotional move you make is logged, aggregated, potentially matched to your identity later. The more you flail, the more data you generate for the very system you're worried about. If your strategy is physical metal, zero leverage, multi-year horizon, then a wartime smash and a new reporting mandate are not reasons to abandon ship. They are a test, a filter, a chance for weak hands to be separated from their metal. You do not want to be in that group. Rule 4. Make paperwork your ally, not your enemy. This sounds backwards when we're talking about surveillance, but it's important. Being sloppy, inconsistent, or deliberately opaque can make you look exactly like the kind of person the system is built to target. If you're ever questioned about source of funds, or cost basis, or patterns of behavior, having clean receipts, clear logs of transactions, a plausible, boring story is far safer than, I bought scraps of silver in random cash deals for 10 years and kept no records because I wanted to be invisible. The invisibility myth is how people end up, accused of structuring, treated harshly by automated flags, in fights they could have avoided with a bit of organization. You don't have to volunteer more than the law requires, but you do want your own house in order. Here's the real takeaway. Silver isn't dumping because it failed as a safe haven. It's dumping because war headlines gave manipulators cover to spring a trap on leveraged and emotional traders. COMEX and banks needed a breather in a physically tight market. And quietly, the reporting and surveillance framework around critical assets like silver tightened another notch. Section 47 isn't about stopping you from owning metal. It's about knowing who owns it, where it's held, and how to fold it into a systemic stability response if things truly break. The safe haven lie is only a lie if you're over-leveraged, all in on paper, and judging your success by 5-minute charts and trending hashtags. If your plan is real metal, real bailment, real time horizon. Section 47 becomes a serious risk to navigate, but not a reason to quit. The retail corpses from this war trap, the ones who panic bought paper then panic sold metal, will not be around to see what happens if the physical market truly reprices. The survivors will be the ones who understood the law, understood the logic, and chose structure over noise. Don't be the one screaming that silver failed because the price dumped during a crisis. Be the one who saw the reporting laws coming, the institutional vultures circling, and positioned accordingly. If you want that second path, stay with us. We're going to keep digging into the parts of the plumbing they hope you never read. RateScope. Logic, not hype.